Hello, and welcome to the Solutions Scoop. I'm Ravi Venkatraman.
And I'm Amanda Tepper. Ravi and I are co-founders of the Chestnut Solutions Institute, an independent forum dedicated to advancing the future of the investment solutions industry. Here at The Scoop, we examine the latest solutions marketplace developments and speak directly with solutions industry leaders. Our guests span the investment ecosystem, from OCIOs to asset owners, investment consultants, asset managers, and other key industry stakeholders.
These conversations are an important part of the Institute's mission to improve transparency and help establish standards and best practices across the solutions industry by educating asset owners, providers, and all other industry stakeholders. Let's get to today's scoop. This is a special episode that features Carol Geremia, President and Co-Head of Global Distribution at MFS, and you can check out Carol's bio in the show notes. Carol's TED Talk style presentation today was recorded at the Chestnut Solutions Institute Spring Forum in Boston in April 2025, where she delivered the keynote address. Carol has worked with MFS's clients all over the world for over 40 years, and she has challenged her own firm and all of us in the investment industry to play a bigger game. So without further delay, here is Carol.
I'm delighted to have a chance to talk to you about playing the bigger game. I will tell you, it's a presentation/conversation that I have been building for years around travel around the world with investors in every region you can imagine. And it's intended to push on things that I cannot tell you MFS is solving. It's the idea that we all probably need to think about how to deal with disruption and the opportunity of whether we truly are as an industry fit for purpose in the future. And so what I have been trying to do, even with myself, but it's self-reflection at MFS, and is to challenge ourselves. So part of playing the bigger game, and we've been working on this at our executive team levels, is a philosophy and a mindset. And so what we really started doing about 5 years ago was this idea of challenging MFS, challenging the world and the industry about alignment or the misalignments that we see. And part of the bigger game was really just trying to get us to take us out of our comfort zones and really start thinking big, differently, and dealing with not the short-term noise, not just all the, what I call sort of the financial gossip that we are absolutely obsessed in focusing on, and to step away to really think about the ambiguity and the uncertainty that we're really all dealing with. I mean, the disruption we're dealing with is so much more about big signals, about the shifts of the capital markets. To me, that's what I get the most excited about, but our industry has a tendency to want to go back to our comfort zones and focus on the stuff that we think we can control, but it's actually all the stuff we can't control. So the idea of playing a bigger game is to sort of do a collective discussion where you're not trying to immediately solve, you're trying to actually really talk about the possibilities. The other thing that I love about the idea of playing a bigger game is challenging us to sort of clear the unsaids. And some of that is what I'm going to do today, and again, would love lots of your opinions on it. But what the gulp box is really about is to just sort of put it on the table, because I think we end up having a tendency to not want to clear the unsaids because it's the fear of not getting it right. You know, the pressure of the client, the pressure of what we deal with every day as a human capital industry is the fear of getting it wrong. And I see that all the time at MFS. And it's like trying to push people to say, you know what, guess what, let go. Let go of trying to solve tactical and practical right now. Because the time we are in, I've been doing this for 41 years. Many of you have been in the industry for a long time. This is very, very different in terms of change. And it's not unprecedented change. We've all seen massive amounts of disruption, but this is evolving change that actually there's massive opportunity to capitalize on. And it's about sort of stepping out into being uncomfortable. So that's essentially playing the bigger game. So it is an opportunity also to think about new allies for the future that you would never have thought about before. And I really say that. I think today, whether it's regulators, whether it's other forms of partnerships that you have not thought of, I think, again, we're in ripe opportunity to figure those out. Oh. And the idea of bold action is what I'll get to a little bit at the end, but hopefully that will tee you up for a great conversation for the rest of the afternoon or the morning. So, who should play a bigger game? Anybody can. Actually, the way the training really goes is you can use this anywhere. You can use it at home. You can use it in your work. But it is about just sort of where you are on the 9-box grid. And when I think about who should play it, the idea is all of us, right? To really think about the end investor and the public company and the influence that has been created by all of us in the past 30 to 50 years has been tremendous. And I think because we're all so focused on holding each other accountable, that sometimes forgetting about the real world, and I don't mean the institutional investor, I mean the beneficiary, the real world. Unfortunately, we've grown disconnected with sort of some of the realities there. And I've heard that time and time again from the CIOs of the largest pension funds in the world. They said, we're not tapped into the real world. I think we have an opportunity to think about what that looks like. But the other thing is, when we think about corporate America, when we think about all the public companies we invest in or the private companies we invest in, I think we underestimate sometimes how much influence we have on the behavior. And that is also what I want to hopefully kick around with all of you. State Street, I have admired some of the work they have done. It dates back like 15 years ago. In fact, I don't think they have the group as it was organized in the past anymore, because I think what they were saying was so radical and nobody wanted to hear it. And two of the papers, one called The Big Shift and The Folklore of Finance, I still would suggest reading it. It bothered me the first time I read it. It bothered me again. But actually what they were doing was playing a bigger game. They were putting the truth on the table, and it was disruptive, and but it also sort of took me into coming out of the comfort zone to say, hey, I want to challenge the misalignments that I see, even in MFS, and how we're showing up. So I loved sort of the cover of The Big Shift, the paper, the idea of what if our actual purpose is closer to our stated purpose? What if we make our center of gravity more human-centric? Now, how ironic in the world of froth around AI. I spent like hours listening to that yesterday, and I was both incredibly amazed and educated to absolutely saying, what are we doing? What are we doing? And we're all kind of going through that. I'm interviewing the Chief Technology Officer of Bloomberg in Washington next week. And, I'm going to pull out of Sean Edwards, both, the paranoia I feel, but also the opportunity that I think we're going to see over the next 5 to 10 years. Let me just tell you, in the paper, The Big Shift, and I have also used this a lot, we all talk about purpose in our organizations now. In the past 5 years, it's been, again, sort of an overused term. What I liked about how they teed up in The Big Shift was the idea of crystallizing the purpose of our industry. And they actually broke it down into 2 pieces. And I'm paraphrasing, but I think it's pretty close. And that is, our goal is to drive economic prosperity by allocating capital responsibly and helping investors meet their financial goals. This is a 2-part process. And this is what part of playing the bigger game is, the conversation I'm having with a lot of investors. And I'm going to unpack that, what I mean. But we focus on returns, client, all of that, which is critical. That's what we get paid to do. But the idea of how we are participants in the capital market and the condition of the capital markets today is probably what disturbs me the most. So there's no question why we're here. Like, to think just, and Callan puts this out every year, and I've got to keep updating it. The bottom line, as many of you know this slide, is just to remind ourselves how much more risk we have been building and taking over the past 30 to 40 years to get the same amount of return. I mean, it's really kind of crazy. And even when we talk about interest rates and they've got to come down, when I bought our first home, the interest rate we paid was 11%. We've been in such different dynamics, but we've got this complex asset allocation point that we're in today that has been both very important to the growth of our industry. But here's the deal. So when you look at the capital markets, and again, this is time and time again, I've seen this slide and I've kept up with it because it does make me want to have us look at the industry and what our role is and how it's evolved in the chain. But in 1945, and you could even, when I started in the industry in 84, the fact that the public markets today, 95% of the public markets are owned or overseen by all of us versus when I started in the business, it is unbelievable. Like, professional investment management has absolutely gone through the ceiling. So all the different layers of all of us between the end investor and the public company is like grown massively. And we all have to hold each other accountable. But the part that I am going to, well after I leave this industry, still going to harp on, is we have a time horizon problem. Professional management has gone through the ceiling. We have more complexities. They need advice, and they will need more of it in the future. But what we have done is the average holding period of a stock, many of you know this, has gone from 8 years to 5 months. I will tell you the results of this and how it's playing out in big signals is not a great result, period. And there's so much opportunity to think about how we influence this and our part here, because I'm pretty pragmatic and I like success and I like to grow and all of those things, because a lot of times people say, oh, this is above my pay grade, Carol. The system's never going to change. Oh, yes, it will. And what I want to make sure is we're not going to be left behind. We're going to be one step ahead. And again, when you think through 100 years in studying MFS's history, it's unbelievable at the times when we haven't led, we've kind of sat back, and the times where we actually said, now is when we have to lead. So I call it a bit the war on short-termism. I have not had disagreement with any large institutional investor anywhere in the world about this issue. The challenge is, nice try, Carol, but there's nothing I can do. I sat with one of our large clients in Canada. We had an amazing conversation. There is a lot we can do. There is so much we can do, and I'll give you some examples of that. But what we've also had to do in dealing with the risk that we're taking is to realize we've had to diversify this risk. So when I started, I remember people weren't even interested in getting into the equity markets. Can you imagine that? We had to convince people to buy stocks. Today, most people entering the industry, they could never imagine. But what we had to do as the complexity and returns were scarce and rates were low for so long, we had to figure out how to diversify all this risk we started to take. So we did a pretty good job. We have the growth of passive, but I am going to tell you unintended consequences in all of this shift to the complexity we have built, both in passive, liquid alpha, traditional active, the alternatives, the illiquid alts, and the rise of ESG, or not. Because we've got risk built that I think we don't talk enough about. We spend so much time focusing on the financial gossip of tariffs and interest rates and recessions and all the stuff we cannot control versus the massive signals that are actually being developed in the capital markets. So, starting with the risk of passive. And I'm going to say, I've been at MFS for 41 years. I believe heart and soul and mind in active management. And I do say in every interview, if you don't believe in active management, don't come here. And yet, I understand the role of passive very much today and the importance of it. But I also am going to wake up the industry to say, we have an issue here. And Jack Bogle was in our offices 18 months before he died. It was such an amazing meeting. There was 10 of us in the room. He said two things that I wrote down and I will always carry with me. One, I never expected it to get this big. And two, I'm not sure how we're going to deal with sustainability. So his point, and then he did, I can say that, but then he did get interviewed by Forbes. And what he said to all of us is if the public markets get to over 50% of passive capital, we will have chaos. And if you listen to the quotes, it's just basic. It's basic concentration, it's basic lack of governance, and again, just a wall of money. Guess what we took out of the public markets? Now, this is my opinion. We've taken competitiveness out of the public markets because everybody gets flows now. Nobody's fighting for flows. You're getting flows no matter what if you're in a benchmark. And I'm going to show you in a moment that we have 2.4 million indices to 43,000 stocks. These are just things we should be thinking about and talking about. It's not to beat up on passive. Passive has an important role. Well, one of the best things that was said to me to continue to have this dialogue was to one of our largest clients, which is the largest pool of capital in the world. He said, we have to care about active management. And I laughed and said, hey, thanks, why? Ha, ha, ha. And he said, because we have the largest pool of passive capital. What I see here is a huge opportunity for us to finally stop putting passive and active against each other and start defining the roles of the two styles. And I love, if you have not followed Focus Capital on the long term, it's an organization that, by the way, one of the founding members was Larry Fink. Focus Capital on the long term, I have been involved in, and MFS has been for a long time. But they do a lot of research on fighting the war on short-termism. And when I go to their annual conference, hosted at Bloomberg, I'm sitting with the largest CEOs of public companies in the United States and the world, and they're really, really trying to fight on the idea of getting better aligned investors. It's crushing their companies, they know it, and they're sick of it. Now, are they doing anything about it? No, but we're here collectively saying we got a problem. And that's why, again, having this conversation today is not something that I've made up. These are years in the making of something that we all have to be paying attention to. One of my favorite research papers that was done last year, Sarah Williamson, who was from Wellington, is the CEO of Focus Capital on the long term, and she's fabulous. She wrote a paper that, again, I think just summed it up. She said, let's look at the Pepsi and Coke story. 50% of Coke's shareholders don't care if Coke beats Pepsi or not. In fact, they don't care about Coke really at all. And so here are some of the stats that I think are important to frame this, and you can read the paper at more length, but she segmented the investors of Coke. 28% are retail investors. They're on the Coke team. 6% are short-term hedge funds, trading the stock or the price pattern, but not thinking about Coke's long-term success or failures. 25% are passive and own Pepsi too, and are very indifferent in who wins. And fourth, 42% are active managers that are under or overweight the benchmark. Half of them are underweight and hope Pepsi beats Coke. So what you'd hear the Bloomberg event was in February, what you would hear from them is that they're sitting with investors that don't care about their long-term strategy, they don't care what they do with their employees, they don't care really about anything. It's just, the quarterly results. And that has not dissipated like we have all sort of wanted it to, but we forget about the influence we have on that behavior and how massive it has become. So the impact to the active management industry, as I say, have we just dumbed down the public markets to realize that stewardship, proxy voting, engagement, that was an ESG thing, none of that matters? You got to be kidding me. It's the only way that you can get decent price discovery to allow the public markets to survive. If we continue to load up on just endless passive, it's over publicly. So you might say, oh, don't worry, we got the private markets, that's going to be fine. I would suggest we have to look at that risk. Until there is full-blown transparency and liquidity, we should be protecting the public markets with everything we have. And we can't walk away from what's happening here. What's happening here is the fact that, again, we've anchored as an industry to 1, 3, 3, maybe 5. We say 5, but it's really 3 in terms of generating alpha. You don't generate alpha in 3 years, you're toast. That is insane. That's speculation, it's not investing. It's chasing, it's hurting. And that's what I would say we have to break the most. Because a full market cycle, we've literally thrown the idea of a full market cycle out. The reason the full market cycle was ever in existence was purely for resilience and risk management. The average full market cycle, and I challenged MFS, I said, if we're going to say full market cycle, our goal is to outperform over a full market cycle, damn it, we have to define a full market cycle. And everybody's like, no, don't do that, Carol. Don't do that. Then don't say it. And I mean it. I said, pull it out of every book. Because to me, the industry has now defined it. The marker was the 3-year to the longer term destination. It is now the destination, and that is not how to allocate capital well with other people's money. That's just chasing and hurting. And so whatever drawdown you look at, and by the way, we did this recently, I asked them to update this. If you look at 87, the average market cycle, full market cycle, peak to trough, is 11 years since 1987. So it's actually gotten longer, right? But here we've done a global study year after year around this to say, so let's not MFS look at our history of 100 years, and this is not just MFS's history, it's actually the market's 100-year, 115-year, I think. But we said, why don't we ask the world what they think a full market cycle is? And the industry knows. I was always taught, the day I started here, is to think beyond 7 years. Even when I was on the phones, I was like, what a full market cycle is. The industry knows that. The tolerance, the pressure, the career risk is the tolerance for underperformance is 3 years. And I always say, if you don't like Warren Buffett, or you do think he's probably the example of the best long-term investor, if you were to rate his skill on 3 years, even 5, but let's use 3, he'd be underperforming the S&P 500 right now 42% of the time. It's probably the most valuable thing you could pay for. And when I say negative alpha in this organization, people like you are like, that is what people pay you to do, is to be counter-cyclical at the right time. We have to be thinking about resilience. And we're obsessed about uncertainty and all this. And this is the opportunity, is to help clients understand the resilience. And I think, actually, many of you are stepping into this big time. And I'm going to show that in a moment. But here's the 2.4 million indices. It was great, a great paper, as somebody was defining, the passive market and indices and comparison and what, and somebody, a large European pension plan, said, I was in a small working group on some of these issues, and he said, what I'm realizing is that the industry's gotten really good at moving capital, but we're not investing it. And I said, wow, that hits home. Because when you have, to me, it's when the index, when our measurement bar to measure accountability became an investable asset in 1970, we changed the game. It didn't matter for decades until now. And that's why Jack Bogle said that. I never expected it to get this big. So, and this is 2.4 versus the 43,000 companies. And I do wonder who that's good for. So the other thing I spent a lot of time on, and again, I don't know why I have a 2024. It's basically the same number. I've been doing this since 2018. But I've taken every 5-year period because this is what I want to challenge MFS on. And we've been working on in a project called client alignment. And I have what I call my misalignment file, and it was very fat when I started. Ravi knows it. And I wanted to pull out the activities to show how are we showing up. If we say full market cycle, why are we highlighting the 3-year number when we walk into our mutual fund board? And then portfolio managers walk out and they go, man, they don't understand. Like, that's not okay. We need to change the conversation with the board. We did, and I'll tell you about that in a moment. But here's what happens. We go to the top quartile, we want to measure everything, we want to, and essentially every time period, almost every time period, 50% of the top quartiles, you all know that, go to the bottom half. And then when I was at Lockheed Martin, they asked me to come in and talk to their investment team about culture and about time to align. And what was interesting is their fixed income CIO said to me, okay, this we're going to use with the board. But he said, you got to do me a favor and tell me what happens to the bottom quartile. And so I literally did the exact same data. I had no idea, and the exact same thing happened. It just reverses itself. So if you look at some of the academic papers that have been done recently, people are quantifying the impact to the end investor of the hiring and firing of active management. It's costing the end investor 80 to 150 basis points a year. What worries me is that noise gets louder. And that actually is what continues to be the hovering lack of trust that we do not want to continue to build. It still is hanging over from the global financial crisis. And we could say we're fine from that, but I would really say I think we can do better than this. The last piece I'll make in terms of the risks that we have pretended, but I think it again, when I look at where we went with this, the whole ESG thing, I'm going to tell you, is not dead at all. It's not dead. It just never should have been some separate thing. All it is systemic risks that we no longer, and now it's an investment risk, and we no longer can ignore. And we can't ignore artificial intelligence, and we can't ignore cybersecurity, which is going to cost us a fortune, just like climate change. And if you haven't talked to a public company recently or an asset manager that you work for about the ransomware attacks, I go through 5-hour trainings about how we're going to pay terrorists. That is just normal part of business. But we know that's real, but we say then ESG was something. No, these are systemic risks that are embedded now that companies are going to have to deal with, period. And it's the same thing for the war on talent in the future. It's not DEI. So when you look at these statistics, all you have to do is look at the facts. And what I tell my kids is almost when I was born, but not quite. But in 1950, there were 2.5 billion people on the planet. There are 8 billion today. That's a 70% increase of people on the planet since basically I was born. That's insane. That's why we have what we have. You don't need to, there's no debate here. And so we need to not think of it as a separate thing. I am very thankful we didn't have ESG products. We fought really hard to do that because when we were one of the first large US funds to sign the UNPRI, which we have not defaulted on or not signed, these were basic principles of long-term active management. That's all it is. All we're doing is defining the fact that there's no free lunch anymore. These risks are real, and now they've made them their way into cost of capital and cost of running companies. And I can tell you stories about the cost of capital to MFS dealing with all of it is very real. So, by the way, there's an opportunity. To me, what I get the most excited about, especially for advice, especially for OCIO, is it's going to get more and more important because this has just gotten more complicated. But we can't pretend that these are the bigger signals, to me, that are bigger conversations with clients than inflation, interest rates, and the financial gossip. Because this is how to build resilience. And when I am having these conversations, like we are fully engaged. If you want to read a great paper, again, I ended up picking up the phone after I read this paper. A lawyer sent it to me and said, you got to read this paper from Leo Strine out of the University of Chicago. And it was fabulous. He basically, said the win-win that wasn't. So he challenged the economic theory of Milton Friedman in the 70s that shareholder primacy would dominate and maximizing profitability is the purpose of a corporation. So that is truly what we have been committed to for decades now. And and you got to read his paper because he's got statistics and facts that sort of took my breath away. But he basically has said the theory that maximum profitability of a corporation will give everybody opportunity. It will flow into making sure the employee gets paid, making sure that the community, all of the things that will be the residual impact if maximum profitability wins. I think what I would tell you, and this is where I called him and said, here's where I think I would challenge, especially in the public markets. And it's the same thing's going to happen in the private markets. If you talk to anybody that's recently either been bought out by a private company, nobody's thinking long-term and nobody's thinking about employees or anything. So the interesting thing is he did not put enough in the paper about having interest rates and the cost of capital so low for so long. So it distorted everything, right? And then the second part of it is he never imagined so much passive capital in the public markets. Because again, it doesn't matter. I'm just exposure to risk. I don't really care what you get paid. I really don't care how you're running your business. I don't care about your long-term strategy. I mean, that is really how this is playing itself out. So how is it popping out? Are we going to go to this stakeholder view? No, we're all too it's about returns and we got to. That's not going to not go away. But the future is going to be different because none of these risks are going away. And that's how you have to build the resilience. So moving quickly, and then I'll stop, to really, this gets back to State Street's Folklore of Finance. Again, it's worth a read. It's a short paper. But what I liked about it, and it was this, here we are as an industry holding all it, and I don't blame anybody for where we are. We've had to take more risk. That was put on us by interest rates and capital markets and everything. The globalization, the opportunities, we've done an amazing job as an industry allocating capital in that world. But it's all been this idea that if we can just measure more in shorter periods of time, we'll be okay. And actually, as good investors, it's really the exact opposite. This is giving us a false sense of comfort that we're doing the right thing to eventually help the end investor get to where they need to go. This is where I see advice, CIO, the opportunity of what you're going to talk about, I think, in the next couple of sessions, value creation. That is where the innovation comes from. And by the way, if we don't get on it, the technology companies will. Because we have to define long-term value creation. Because that's actually what you could look at the buying patterns of consumers today. It just hasn't hit us yet. So this idea of just going and looking at past returns and thinking we can do all of this stuff that we've done in our comfort zone of the past we're in the middle of disruption now. I think what they wrote, I think it was 2017, applies now more than ever. But they predicted this, and it was really well done. The CFA does their trust. This is, again, where I'm most focused on trust. Trust is that the end investor never said highest return at any cost. They never said it. In fact, they never have voted on that. What they really want to do is, please act in my best interest. And so what I'm suggesting is that the future is we're going to allocate capital differently because we'll have no choice. And that's what's in their best interest, is how we're putting their money to work in the capital markets, not just exposure to risk. I'm going to just get exposure to risk versus really caring about what I own. We have to own great companies that are going to do great things. And that's, I really truly believe we have this opportunity of defining what's in my best interest. And those that step into this are really the ones that are going to differentiate themselves. My husband has been an advisor, by the way, for 38 years, and my son's one. They work together. So I appreciate, his purpose is to help his clients have a healthy relationship with money. And when they say to him, Steve, why didn't this fund outperform the S&P 500? And he gets it all the time. And his simple answer to them is, I had no idea you wanted to take that much risk. And they say, what? And then it's his opportunity to step in on how he is allocating their capital better than just a passive approach. So here's where I think a lot of the large conversations I'm having, we're working with MIT, we're working with the CFA, we're working with Keith Ambashear. I don't know if any of you know Keith. He is one of the founders of the Canadian pension system. He has been writing about this for years, is to start with new measurements of success. We don't have to abandon beating benchmarks. We can hold on to that as long as we need to, forever, for that matter. But there are a new way to also help people understand how we're putting their money to work. And by the way, they're going to care. They're going to care. So I think, this idea of performance, alpha against what? So some of the things that we're doing is alpha against a fixed bench. I mean, you just look at your long-term active managers that have done a really good job, know every company, engage, proxy vote the right way. Everything you would want a steward to do with your client's money. You just simply look at the cap-weighted benchmark versus a fixed-weighted, and you just see night and day. So who said cap-weighted was the way to go when the world now owns the largest concentrated growth fund of the S&P 500? Like, who said that was right? Why aren't we disrupting that? Because I won't get fired, because it's easy, because it's cheap. Like, that's not going to be good enough going forward. So alpha against what? Long-term stewardship, one number. The world says they're all long-term. Every website says active managers were long-term. Tell them to prove it to you. There's only one number you should ask for. What's your average holding horizon of a stock? It's a fascinating conversation. It's the one statistic that says this is my philosophy. And I'll tell you, I've done a lot of work on this to hold ourselves accountable. If we're going to say we're long-term, let's prove it. So I've taken our 5 biggest competitors on, let's say, our global equity or our large cap value, and I've looked at their average holding horizon and ours. I'm not saying they're bad, they're good. All I'm telling you is, man, we're different. Just from that number. Our global equity average holding horizon is 8 years. Our biggest competitors is less than a year. They may be incredibly good at what they're doing there. I'm not questioning that. All I'm telling you with alignment, we're doing something very, very different. And we're allocating capital very, very differently. And we're engaging differently. And we're probably also voting proxies very differently. And if you haven't heard about the growth of the proxy war issue, it's mounting. So here's where I think I'm going to leave you with your conversation, which Willis Towers Watson did this. We've been working on these conversations with Roger Irwin. I mean, literally, you name it. This conversation is not just here in these 4 walls. It's been with really some of the biggest influencers of institutional assets. But they put this slide together, and I think someone's here from Willis Towers. Great paper, the Thinking Ahead group. But they started, doing some work on how we as an industry have measured accountability, going from the startup era of the 70s, right, when I said the benchmark became the investable asset. It changed everything, right? And we almost treat it like it's cash. It's the Holy Grail. And yet it's so concentrated today, we don't even know what to do. But you look at the alpha era, which is still very much alive and very, very important, by the way. I am not even suggesting that this goes away. It's just potentially in a different construct. Then this ESG area. No, we're just in a messy middle of the fact that the system is telling us if you don't allocate capital differently, we're going to have a problem. And you can see these cycles in time over and over again. And then this opportunity of what I think is why customization and personalization is becoming so important. Because we're going to move to this more outcome-driven environment of stakeholder, because it's not, companies can't operate with actually not operating here to be competitive. You're going to have a lot of winners and losers in terms of being able to define just this, or how they actually are adding value. So I'm going to stop here. I have a couple of good examples of bold action, but I do want to open it up and see what you think, throw water on it, disagree. I can answer any questions, but just really appreciate the opportunity to play a bigger game with you for a moment and think about these big issues that I think we as an industry can solve together. And the more we sort of push the envelope on this, I think new innovation's going to come like we never thought of. So I'll just give you the case study, and it's on the Focus Capital on the Long Term's website to look at. We had this dialogue. So our mutual fund board, $400 billion, and it's independently run, and 1,200 pages of board reports. The board performance reports are all different today because we talked to them about this. And the whole idea was, it's not good enough for our portfolio managers to walk out and say they don't get it. And then for them to say that, this is, and have this, to me, it's less about the metrics, it's more about a different conversation that makes them feel better. We're pretending they don't want to have this conversation. I'm telling you they do. I'm telling you most smart board members understand resilience, understanding the idea of allocating capital better. And to set up some of this, I did this presentation 5 years ago. It was a little different. I had a guy that was sitting on 5 corporate boards, and he said, I want to send you a white paper I wrote on my corporate board. He's the one that did all the work on the Warren Buffett data and gave it to me. Was that, so what we did with our mutual fund board was it took us 2.5 years to change the reports. It's not monumental, but we start with the 10-year, then it's the 5, then it's the 3, then it's the 1. They dropped the year to date. We didn't even they said, how do we create better alignment? So it wasn't just, because part of this is about investment beliefs and investment culture that I think we can all lean into more, that we sort of are just saying, they don't want to have and they might not, and they won't from day one. But the other thing is we changed the attribution to 10, 5, and 3 years instead of 1. When you just have attribution 10, 5, 3, and 1, the data is so different, it's fascinating. These smart people want to go, look at the 10 versus the 1. Isn't that incredible? So our portfolio managers are now not having this, they're having the conversations they should be with the board. And so that's kind of what I would challenge all of us. I think we're and I sat in front of a large public company. They asked me to come in and have this, and it was uncomfortable. But you know what? They were like delighted. And you're not going to get it everywhere. The whole point of this, by the way, is measure me every nanosecond. That's not the point. It's the end investor I'm worried about. And I would say that. And that's what I say in the board. If you want us to take care of your shareholders and allocate capital well for the system, You can't have us beating benchmarks in short periods of time all the time. There's nothing that's aligned. And then nobody's going to argue that. I mean, all I have to do is go back to two periods I lived through, the financial crisis and the tech bubble. I mean, when you think of the financial engineering and everything that we did before I kept saying to myself, God, I'm not sure I'm smart enough for this industry anymore. It's like that was the lie I was believing. You know, liquid alts, absolute returns, like loaded up. And what did Bernie Madoff say from jail? Sorry, what did he say? He said, the more I told them they couldn't see my secret sauce, the more money I got. You know, I mean, and then the tech bubble, like I could go through, and I was around for 87 too. You know, I think heard James Davis, who's the CIO of Ontario, OP Trust, sorry, not Ontario. And then Karen, she is the CIO of Bridgewater, had one of the best slides I've seen in a long time. She stood up in front of an entire audience of big pools of capital, and she said, at what point am I not going to look like an idiot? We have to stop doing this. And she had one slide, we recreated it, and I told her I would. I saw her at the Bloomberg event. And she had sort of resilience. Here's the benchmark, here's the resilience. And she said, right now, I'm not going to tell you to build resilience in 2009. You know, it's like, what did you do to outperform the benchmark in the global financial crisis? If you were building resilience and looking what was happening, you were outperforming by 2009, you were blowing past the benchmark by hundreds of basis points. And I think we say that this can't change. We can't. This is how everybody. No, it isn't. Here's what I would say. Listen to my husband's clients. They're not asking for alpha. They're not asking for alpha. We have to generate alpha in long periods of time. But we've distorted that conversation about actually what they need. You know, most of the advisors are sitting there to the end investor, the real world, is actually saying, I'm not sure I can put my kid through college. I just got divorced. My husband just died from a bike accident. I mean, literally, these are things that I know that advisor is dealing with at the end investor level, or quite frankly, the beneficiary of a retirement plan. That, I get it, but this is what I hear. It's like when I look at history, history says the best leaders are going to deal with this issue. And I think that's why I think the OCIO movement is incredibly valuable. We do, being owned by a public company and also having an independent board, I actually think it's in the dialogue of this idea of playing a bigger game. Because I don't think any of the smart people around the table don't recognize some of it right now. And I'd be surprised, because I would have stopped talking about this a long time ago. I'm pretty I know when I'm going to get thrown out of a room. I mean, and I really, there is the level of people not wanting to hear it, but I actually think the sale is the one that actually is going to tell it. That's to have seen our board. Now, did it take 2 meetings? No, it didn't. It took 2.5 years. But you know what? We stepped away and they took it on because they wanted to change the culture. They had new people coming in. So it actually bonded them. I didn't even expect it, but that's part of playing the bigger game. It's like to trust that I don't have all the answers. But all I know, if you want to trust me in business on anything, I got to build better alignment. And what I'm watching, is the past, we're really getting to points of alignment that we need to wake up on. I don't care how you do it. But it's like even, the same thing at the advisor level. The most valuable thing an advisor could do is not hire and fire a manager and say, hey, this is what I do, is to keep their investor in the market. And they could build They could build a whole marketing campaign around resilience right now and build trust where half the advisors, they'd crush. These are the opportunities that I think we go to that comfort zone. This is above my pay grade. I'm not touching this one. And by the way, the younger generation, watching my son as a young advisor, not only are they terrified of the risks we took, they actually do think longer term than we're giving them credit for. It's from an investment perspective. So I think what we're talking about is an opportunity to educate and empower, however you want to do it. And there's some amazing boards, pension boards, that have incredible cultures, that have built this resilience idea of, you're not coming on our board. We're going to hire people that have a long-term view, because that's risk management. More risk we take, less time, that's called speculation. These are opportunities onboarding, even if you have high turnover, is the ability. The head of Pepsi now says, short-term alpha is a disease. She said, I am onboarding people differently today. Focus Capital on the long term has just written a paper about companies segmenting their boards and investors to say, you know what, I'm not going to talk to people that aren't aligned with me anymore. So I'm not saying, but I think there's a lot of opportunity to step in that, and not just, oh, we want you on our board. People all over the world want to be on boards. Guess what? This is how you're going to be on our board. And that's the culture that I think you have an opportunity. And quite frankly, people are more proud about what they're doing. So I think you're going to talk about this. I'm on the agenda. So Keith Ambashir, what CPPIB put together, it's now a team of 40 people called the Value Creation Group. And, James Davis would say, benchmarks are the bane of my existence. We're not doing it anymore. I need to do our board, but I'm going to stand up. And so the Value Creation Group, and we actually have established one at MFS, is to start brainstorming with partners, new allies, including the regulators, I might add. We have the FCA in here. They're fascinated about, value for money. Value for money is defining that. So new metrics Kim knows it. We're putting together a dashboard with MIT and Keith, and we want anybody to beat it up. Measure us all the time, but measure us on the role we should play in the capital markets for you to make sure that we are not only getting you a good long-term result and generating alpha over the long haul, but that we're putting your money to work the way you would expect us to. And those are the pieces that I think is the value creation measurement model, and Kim can share some of those. And the beauty of the OCIO market, to me, honestly, that's the solution to a good majority of this. And I do want to leave you with the idea that we need to protect our public markets. And by just treating it as a basket of stuff that we're going to be exposed to is not good enough for the future. And so besides the returns and the client and all that end, is to help them bridge this idea of the companies you work for better be running a great company. And guess what? We have the majority of influence, not just their board. It's us. And that's the part that I think is we can walk into to say, we got a dual purpose here. We got to make sure those public markets are the best they can possibly be, especially in the world, because they happen to be the biggest. And why we're throwing them away as just exposure and we don't care what's in them, that's the biggest opportunity. Thank you so much. Thank you for being here and listening to my soapbox. Cheers.
Chestnut Advisory Group is a boutique, practitioner-led management consulting firm dedicated to asset managers and investment solutions providers. In addition to the Chestnut Solutions Institute, our advisory practice areas include distribution strategy, M&A support, go-to-market, and implementation and coaching services. This podcast is owned and produced by the Chestnut Solutions Institute. If you like this content and would like to access more insights, webinars, and podcasts, please check out our website, chestnutadvisory.com.